Agency, partnership, part one. First of all, let's discuss our sources of law. We have two sources of law in partnership. The first is the UPA of 1914. The second is the revised Uniform Partnership Act of 1997. The significant difference is in how the partnership is characterized. Under the UPA, a partnership is an aggregation. The partners are the business and they are not a separate legal entity. Therefore, the partners are, this is key, joint principals. The partners are the business. The business follows the aggregation theory, and the partners are joint, that's right, principals. And therefore, under the 1914 Uniform Partnership Act, if one partner leaves or dies, the partnership is, you know it, automatically dissolved. Now, the remaining partners, this would trigger dissolution, winding up, and termination of the business, correct? Yes. Can the remaining partners continue in business together? Remember, a partnership is what? An association of two or more persons to carry on a business for profit. Yes, of course they may. The remaining partners may reform a new partnership and continue to carry on as co-owners of a business for profit. Under the UPA, remember the partners are joint principals. They hold assets in common. They can have a partnership agreement, and that partnership agreement can actually modify just about any term. There is one other important point. Under the UPA, partners are the business. So, do you think that under the UPA of 1917 or 14, do you think partners can sue the partnership? No. Under the Uniform Partnership Act of 1914, the partners are joint principals of the business. The partners may not sue the partnership. The partners may not sue themselves. Okay, second source of law, the revised Uniform Partnership Act of 1997. This did away with the aggregation theory. The partnership under the 1997 revised Uniform Partnership Act is a legal entity unto itself, and it is separate and distinct from the partners. What are the advantages to this? The partnership can own assets in the partnership name. The partnership can sue in its own name. The partners can sue each other or be sued. But the big one here is that the partners are not the business. The partners are not joint principals. The partners are agents of the partnership. Okay, quick review. Under the UPA of 1914, the partners are the business under the aggregation theory, and therefore the partners are, that's right, joint principals. So if one partner leaves or dies, what happens to the partnership? That's right, automatic dissolution. Can partners in this type of partnership sue each other? No. Under the Uniform Partnership Act of 1914, partners may not sue the partnership because they cannot sue themselves. If the remaining partners, after a partner leaves, want to continue in business, they must do what? That's right, reform a new partnership. Under 1997 revised Uniform Partnership Act, the partnership is that's right, legal entity, and it is separate and distinct from the partners themselves. The partners are what? They're not the business, they are agents of the partnership. They are not joint principals. And this means that when a partner leaves the partnership continues to exist according to any agreement that there is. Okay, moving on to creation of partnerships, which is our main topic for this video. Remember, a general partnership, no formalities are required. No agreement is required. That is why people can unintentionally enter into a partnership when they don't even intend to. A general partnership is the association of two or more persons to carry on as co-owners of a business for profit. Repeat, a general partnership is what? That's right, the association of two or more persons to carry on as co-owners of a business for profit, whether or not those persons intended to form a partnership. Okay, let's break that down. This is important. Association. It's an association. That means it's voluntary and consensual. Two people voluntarily and consensually associate with one another. What does this mean? It means that people don't need to understand, hey, I'm creating a partnership here. They simply need to voluntarily associate. So that is element one. A general partnership is what? That's right, the association of two or more persons to carry on as co-owners of a business for profit, whether or not the person's intended to form a partnership. Association must be voluntary and consensual. You don't need to understand. You just need to do what? Voluntarily associate. And the two or more requirement is just more than one to an infinite number of general partners. What about a person? It's the association of two or more persons. Does that mean a natural person? No. A partnership can be formed by natural persons, but it can also be formed by corporations, limited partnerships, and natural person can have a partnership with an LLC, an LLP, an LP, whatever, as long as all the requirements are met. A person is not necessarily a natural person. There is one limitation on this rule, and that is if we have a corporation as a partner, their liability is limited to the extent of its corporate actions. Remember, corporations have legal personhood. They have a fixed amount of assets. The purpose of a corporation is to create a shield from liability. Therefore, a corporate partner's liability is going to be necessarily limited to the extent of its corporate assets. Let's repeat the rule again. That's right. A general partnership is what? The association of two or more persons, not necessarily natural persons, to carry on as co-owners of a business for profit. Okay, so we just said the person doesn't have to be a natural person, but if they are corporate, their liability is limited to the extent of the corporate assets. Now let's look at the next element, co-owners. Co-owners, this is not employer-employee. A partner is not an investor or a creditor. A partner is a co-owner with the right to help manage and carry on the business. That's what we mean by co-owners. When a partnership question tests you on somebody making a loan to the partnership for a fixed term and expecting to be repaid with interest, that person is not a partner because they're not a co-owner and they're not carrying on in the business. They're simply loaning money. Finally, a business for profit. What does this mean? A general partnership cannot be a nonprofit organization. It must be for profit, even if it ultimately loses money. A partnership must be a for-profit entity. So let's once again repeat the general rule. A general partnership is, that's right, the association of two or more persons to carry on as co-owners of a business for profit, whether or not they intended to form a partnership. And what's the rule for association? You just have to voluntarily and consensually associate with another person. And guess what? You've got a partnership. Does a person always have to be a natural person? No. But what's the limitation on corporate liability? Extent of corporate assets. A corporation has legal personhood. And Co-owners can't be employer-employee, can't be an investor, and it must be for profit. Okay, commonly tested issues in creation of a partnership include the intent to create a business for profit. Remember, you can fall into a partnership. All you need is the intent to create a business for profit. The agreement is irrelevant. The idea that you think you're going to form a partnership is irrelevant. All you need is the intent to create a business for profit. That's it. So, one example that I've seen tested is we have partners who have the intent to form a limited partnership, and they do what? They never file with the Secretary of State. So we want a limited partnership, and they never filed with the Secretary of State. What kind of business do we have? Oh, yes, a general partnership. They had the intent to create a business for profit. They failed to file the necessary paperwork. General partnership. Okay, so let's look at a general partnership, some of the presumptions of partnership, and they are the proof of partnership generally on an essay exam. 1, sharing profits and losses. 2, sharing management and control. 1, sharing profits and losses. 2, sharing management and control. These are the two biggies. Sharing in the partnership profits creates a rebuttable presumption of partnership. If you share in the profits and losses, that's a presumption of partnership. Share in the partnership profits, rebuttable presumption of partnership. It is evidence of partnership. Does that mean it can't be rebutted? No. Sharing profits and losses doesn't necessarily mean there is automatically a partnership. It's just strong evidence. It's a presumption, like the business judgment rule, that two people are partners if they share profits. It's evidence. It doesn't prove anything. It's a rebuttable presumption. Contrary facts can disprove this presumption. For example, if someone makes a loan or is a creditor to the partnership, if someone is merely performing payment for services, those types of facts can disprove the presumption of partnership. But sharing profits, and remember, losses follow profits, is a rebuttable presumption of partnership. 2, sharing management and control indicates a partnership. It's evidence of partnership. So what does this look like? Essentially, management and control is that we share the partnership responsibilities and the partnership duties. For example, joint approval of purchases, control over labor, control over capital investment. So we've got our two big deal indicia of partnership: sharing profits and losses, and 2, sharing management and control. Okay, 2 more. Title of property. Always analyze whose title property is in. If property is held in the partnership's name, it is, yes, partnership property. What about an agreement? We can create a partnership agreement. Remember, all of these rules about sharing profits and losses, management and control, title of property, these are the default rules absent an express agreement. If there is an agreement, the agreement controls. Okay, one last thing. One can create a partnership by estoppel. As in all other areas related to estoppel, if 2 people hold themselves out as partners, or if somebody else holds themselves out as a partner, a third party, for example, that third party is liable as a partner. So anyone who holds themselves out as a partner is a partner by estoppel. Who's liable? Ron and Jim are general partners. Linda goes to the hardware store and opens a line of credit, stating she's a partner. And she goes and buys a bunch of equipment. And then she doesn't pay. Who's liable? Well, yes, Linda is liable for her unauthorized purchase, but the partnership is also liable. Even if no partnership exists, Linda's actions, holding herself out as a partner, created a partnership by estoppel. The individual is liable, the partnership is liable. Okay, adding new partners. Can you be forced to do business? No, it must be voluntary and consensual. So if you want to add a new partner, whose consent do you need? All the partners. A partnership is an at-will entity. Consent of all partners is required to add a new partner, unless, of course, an agreement provides otherwise. Okay, state the rule for partnership by estoppel. If people hold themselves out as partners, or a third party holds themselves out as a partner, the partnership is liable, and so is that individual. Even if no partnership exists, a partnership can be created by estoppel, or a partner can be a partner by estoppel. And what do we need to add new partners? Unanimous consent, unless there's an agreement to the contrary. Moving on to creation of a limited partnership. So, of course, partners have that horrible joint and several liability. So a limited partnership is created with general partners who have unlimited liability and limited partners who are liable only to the extent of their capital investment. Limited partners, limited liability. Limited partners are the investors in the business. Okay, in a limited partnership, general partners carry on the day-to-day business of the partnership. That is the general rule, and they have joint and several liability for debts and obligations of the partnership. Whereas limited partners are liable only to the extent of their capital investment and don't manage the business. Now, that's a long rule. Let's try to shorten it. A limited partnership is a business that has at least one general partner who carries on the day-to-day business of the partnership and has joint and several liability, and an unlimited number of limited partners who are liable only to the extent of their capital investment and don't manage the business. Limited partners, limited liability. General partners, joint and several liability, but management rights. Okay, how do we form a limited partnership? Unlike a general partnership, we can't just fall in or back in to a limited partnership. We need a written certificate of limited partnership filed with the appropriate state authority. No statement, no limited partnership. Remember, intent is irrelevant. Depending on the facts, if they fail to file, they might have formed a general partnership, right? But we must have what? To form a limited partnership, we must have a written certificate of limited partnership. And it must be, that's right, filed with the appropriate state authority. And if we don't have one, then you don't have a limited partnership. You might have a general partnership. Okay, so on this document, tell the examiners what's required. First of all, we need a written certificate of limited partnership filed with the appropriate state authority. That's our rule. But what has to be on it? The name of the partnership, and it has to have LP. Why? Because we need to put third parties on notice that they're dealing with a limited liability entity. Okay, and then you also have to have the partnership's mailing address, the name and address of each general partner, the name and address of the agent for service of process, the signature of each general partner. But the most important thing is filing that certificate of limited partnership with the Secretary of State. And we need to have the words LP after the name to put others on notice that what? They are dealing with a business that has limited liability. Okay, so what is the doctrine then of substantial compliance? Substantial compliance will validate a partnership that has minor facial defects. Let's state the rule again. The doctrine of, that's right, substantial compliance will do what? That's right, it will validate a partnership that has minor facial defects. What would be a minor defect? A typo, a slight error in the mailing address, one missing signature, something small. Doctrine of substantial compliance will do what? Validate a partnership that has minor facial defects. You file that written certificate of limited partnership with the appropriate state authority, and it has LP on the end of that name, then other minor defects may still validate the partnership. Okay, just to run through those one more time. We need, number one, the name of the partnership, which must contain, yes, LP. The mailing address of the partnership. The naming mailing address of the agent for service of process. Name and address of each, that's right, general partner, and the signature of each general partner. Hey, where are the limited partners in this document? They're not anywhere. The limited partners don't need to be in the certificate. Period. End of story. If a question asks you about limited partners on the partnership certificate, no, they don't need to be there. They have nothing to do with anything related to the certificate of limited partnership, and their names can't be in the partnership agreement, and we'll find that out later. Okay, continuing on. Next entity, the LLP. The LLP, the limited liability partnership, is in most jurisdictions an entity used only for professional services. Why do we have LLPs? To limit individual partners' liability for professional malpractice. So the purpose of an LLP is to limit malpractice liability. Okay, so for the most part, these are only professional services, doctors, accountants, lawyers, psychologists. Okay, so we have the partnership's liability for professional malpractice is limited to only 3 circumstances. 1, a partner committed malpractice, they're liable for their own malpractice. 2, a partner's supervisor directed that person to commit malpractice. And 3, the partner was directly involved in that specific activity that created the malpractice. So who gets liable for malpractice here? The partner who did it, the partner's supervisor, if they supervised and directed the person and were directly involved in the malpractice. What is the result? If you or your supervisor were not involved in malpractice, you are not liable for professional malpractice along with them. So it limits a partner's liability for professional malpractice that doesn't involve that particular partner. Okay, so what's the purpose of a limited liability partnership? To limit liability for professional malpractice. And who is then liable? Only the partner who committed the malpractice, a partner who supervised or directed the person who committed malpractice, and those persons have to be directly, not indirectly, involved in the specific activity that created the malpractice, the financial misconduct, the embezzlement, the bad operation, whatever. Direct involvement. Partner, supervisor. Okay, so the other people, once malpractice hits, they are not liable in a limited liability partnership. So what are the partners in an LLP liable for? Well, they're liable for the LLP's general obligations, meaning their debts, their contracts, their leases, all of that. What are they not liable for? Well, if they didn't do any malpractice, they're not liable for malpractice or tort claims that are served on the other partners. Who's liable? The individual who did it. The supervisor would be liable if they were directly involved in that supervision. So partners in an LLP are still going to be liable for what? That's right, the general obligations of the partnership, but not for the other partner's malpractice tort claims. Okay, so what do we need to form a limited partnership? What's that statement called? It is called, that's right, a written certificate of limited partnership. Certificate of limited partnership filed with the appropriate state authority. And we have our doctrine of substantial compliance, but limited partnership, don't confuse it. We need a certificate of limited partnership. For a limited liability partnership, we need a statement of qualification. Okay, general partner, no statement. Limited partnership, certificate of limited partnership. Limited liability partnership, statement of qualification. Limited partnership, that's right, certificate of limited partnership. Limited liability partnership, statement of qualification. What do you think that statement of qualification has to contain? The name. And it has to say LLP or RLLP for Registered Limited Liability Partnership, or PLLP for Professional Limited Liability Partnership. Okay, statement of qualification. What do they have to do? Well, of course, they have to file it with the state, but there are other things that the limited liability partnership must do. They have to pay a fee, and they must file an annual report. So like a corporation, an LLP has to pay a fee to the state, and they have to make an annual report. If they don't do this, the state can revoke their statement of qualification. The state can revoke that limited partnership. How many days notice do they need? 60 days notice. If you don't file your fee, if you don't file your annual report and pay your fee, the state's going to revoke your limited liability partnership on 60 days notice. Okay, this isn't the end, because the limited liability partnership can file and apply to reinstate. But watch out, a limited liability partnership requires a statement of qualification with that name, LLP. They have to file an annual report. They have to pay the fee, or what happens? State may revoke on 60 days notice, but the LLP can also apply to reinstate. Okay, so what if we have a general partnership and the partners want to file a limited liability partnership and they have a pre-existing contract? Do you think they're liable on those pre-existing obligations? Oh, yes, they are. They're liable on all obligations incurred prior to creating the LLP, their leases, their contracts. And we have that statement of qualification, right? So the most important thing is that we need the name LLP to put third parties on notice that we're dealing with an entity that has limited liability. Okay, so there are certain things that we need. The street address of the partnership's CEO, state the name and address of their agent, the effective date of the partnership, and the statement that the partnership is electing to be a limited partnership. Okay, let's go through that one more time. The name, the address of the partnership's CEO or any office, the agent for service of process, where do we find them? A statement that the partnership has elected to be a limited partnership, and the filing of the statement of qualification alone establishes the LLP. So what happens? We need all this information up front: the statement of qualification, the fee, the name, the address, the agent for service of process, the statement of intent to be a limited liability partnership. But any changes to this don't affect the status of the LLP or its liability to creditors, to people bringing malpractice tort claims, and errors don't matter either. So remember, for a limited partnership, we have that doctrine of, that's right, substantial compliance. But for a limited liability partnership, No, anything goes. Errors don't matter. Limited liability, isn't that funny? Limited liability partnership, the filing of the statement of qualification all by itself establishes the limited liability partnership. So any changes to that information, such as changes in partners, does not affect the limited liability partnership. Errors in that statement don't affect the limited liability partnership. That's it. The statement of qualification alone is sufficient to establish the limited liability partnership. And that's it for creation of general partnership, limited partnership, and limited liability partnership.